Good morning, students. Today, our topic for discussion is capital market. Before understanding the capital market, I would like to explain what is financial market. Capital market is one of the component of financial market. What is meant by financial market? Financial market is a place that provides an avenue for sale and purchase of assets such as bonds, stocks, foreign exchange, and derivatives. So, in that place, actually, purchase and sale of different kind of money instruments will happen. Financial instruments will happen. So, in the financial instruments are bonds, stock exchange, foreign exchange. The stock exchanges here we are talking about the Bombay Stock Exchange and National Stock Exchange, NSE, BSE. So in all these places, what will happen? The people who have excess money or surplus money will be transferred to the people who require money or shortage of money. So financial market bridges the gap between these two things. So what are the classification of financial market? Before going in detail about capital market, let me explain what are the classification of financial market. Financial market is classified into mainly two categories. One is the money market, another is the capital market. Okay. Now, what is money market? Money market is a short-term market. What are the instruments are dealt in money market? Here, commercial bills, commercial papers, treasury bills, certificate of deposit. All these things are short-term in nature. Then capital market. Capital market is a long-term. Here it deals with the stocks, bonds, derivatives. So highly, that is the example of highly organized capital markets are, we can say, New York Stock Exchange, American Stock Exchange, London Stock Exchange, and NASDAQ. So these are well organized and developed capital market. Okay. So there are two stock exchanges in India. Here we are talking about the capital market. When we are talking about the capital market, immediately we should remember two stock exchanges of India. One is the Bombay Stock Exchange, that will be called as BSE, and National Stock Exchange, that is called as termed as the NSE. Companies list their shares for the first time on stock exchanges through IPO. Then may trade in this shares through the secondary market. Actually, capital market is again subdivided into primary market and secondary market. The primary market, what happened? The first initial offers will take place. In the secondary market, purchase and sale of shares will be taken down. That we will deal detail in the next slide. Here. So here, before going to the capital market components, how it is classified, we'll discuss the difference between money market and capital market. Money market, I already told you that it is short-term in nature. Capital market is a long-term. Short-term securities are traded in money market, unlike capital market, where long-term securities are created and traded in the capital market. So, short-term securities are traded in money market, less than 1 year period securities are dealt in or traded in the money market. Long-term securities are created and traded. Capital market more formal in nature compared to money market. So here rules and regulations are very strict. So it is more formal in nature. But in case of money market, the securities are less risky because the time period is short. But in case of capital market, the securities are issued for a longer period. So there is a high risk. Money markets are highly liquid compared to the capital market because the money market all the securities are converted within a shorter period of time. So it can be the risk associated with money market is less when compared to the capital market. Next. Here another difference is, main difference is, money market helps in meeting short-term credit requirement. Any firm which wants short-term requirement even for 1 day, that is 24 hours, they can approach the money market, they can raise the fund. So most of the organization, they meet their capital, that is working capital requirement with the help of the money market. However, the capital market helps in meeting the long-term credit requirements of the company, like providing fixed capital to purchase land, building or machinery. In simple term, before explaining working capital, you should know the meaning of working capital. Working capital refers to the difference between current assets and current liability, or I can say in other words, it is capital which is required to meet day-to-day expenses. So capital required to meet day-to-day expenses, it is short-term in nature. So many companies approach money market to meet the short-term capital requirement, that is to meet their working capital requirement. But as far as capital market is concerned, only for the long-term in nature, example, purchase of long-term assets, land and building, the companies may approach capital market. Return on investment is high in capital market compared to money market, because when the capital market involves higher risk compared to money market. So I already explained in the initial class, when there is a high risk, high return, low risk, low return. So here, the money market, the risk associated with the money market is less. Automatically, the return is also less. So this is the difference between money market and capital market. Next is a capital market. Now we'll go in detail. What is capital market? How it function, everything. Capital markets are divided into two categories. One is a primary market and secondary market. What is meant by primary market? That we'll see. Primary market is the here primary market, secondary market. Primary market is actually newly issued bonds, newly issued equities. Equities are owner's capital, but bonds are borrowed money. Again, I repeat, equities are owner's capital, bonds are borrowed money. Both are newly issued. So primary market focus on newly issued. Secondary market are already issued in the primary market, will be moved to the secondary market for purchase and sale. So when it is a new for raising first time initial public offering, that will be done in a primary market. Then the next for purchase or sale for listing of the security, it will move to the secondary market. Next. So now what is capital market? Capital market consists of two things. One is the here it is given that one is the primary market and secondary market. Primary market is first time market, second is a purchase and sale of the activities are taking place. Okay, next thing is that here it is given again primary market and secondary market. What is meant by primary market? That is explained in detail here. So the most important type of capital market is primary market or the new issue market. Mostly they will call it as a new issue market. It exclusively deals with the issue of new shares, securities that are issued to the investor for the first time, very first time. Similarly, I already told you, even the bonds which are issued first time is done in the primary market. The main function of primary market is capital formation for the likes of the companies, government, institution. It helps investors to invest their savings and extra funds in the company, starting new brand. So this is the place where two people are mapped, that is people who require money and people who have surplus money. That mapping is done in case of the primary market as well as secondary market. Okay, next thing is that companies, governments or public sector institution can raise funds through bond issues. So there are two sources of main sources of financing for any company. One is the owner's capital, another is the equity capital, equity finance. Owner's capital and equity financing are same. Another is the borrowed money. Borrowed money, they can borrow from banks, financial institutions, or even that is called as the debentures or bonds. Also, corporation can sell new stock through an initial public offering that is called as IPO for raising that money for a project, starting of the project or investment in the project. So the primary market, the party directly buy shares of the company. The process of selling new shares to the investor is called as underwriting. Sometimes what happens, the company may not be able to sell the shares directly in the market. They may find it difficult to sell their shares. So what happens, that time they will appoint an agent, like an agent that is called as underwriter, who will sell the shares, new shares to the investors on behalf of the company. That person is called as an underwriter. The process of doing that work is called as underwriting. So next we'll move on to the money market. Money market is the one of the market classification under the financial market. Financial markets are, I told you, classified into two categories: capital market and money market. Capital market is again classified into primary market, secondary market. So now we'll see what is money market. Money market is the market for short-term instruments that are close substitute for money. Here, it is a liquid thing, easily marketable with a little change of loss. Because time period involved is less, so the chances of risk is very less. It provides for quick and dependable transfer of short-term debt instruments maturing in 1 year or less, which are used to finance the needs of the consumer, business, agriculture, and government. So it provides all kind of financing to the people who can be repaid within a shorter period of time. The money market is not one market, not the only market, but it's a collective name given to various firms and institutions that deals with the various grades of near money. So these are called as the money market. Okay, now the next thing is that what are the instruments dealt in the money market? One of the important instruments dealt in the money market is promissory note. Promissory note is it is a written promise on part of the businessman today to another a certain sum of money at an agreed future. It is simply it means that one party agrees to pay or promise to pay money in the future for that the bill is drawn. So promissory note is drawn by the debtor. So and has to be accepted by the bank. Debtor is the person who has to pay money. So accepted by the bank in which debtor has this account to be valid. The creditor can get it discounted from his bank till the date of recovery. Promissory notes are rarely used in business these days, except in USA. So what happened? The bill is drawn by the debtor, but the amount is due to the creditor. So what the creditors can do? The creditors can discount it from the bank before the due date. So this is called as a promissory note. Next, bill of exchange or commercial bills. What is meant by bill of exchange or commercial bills? Another instrument of the money market is the bill of exchange, which is similar to the promissory note, except in that it is drawn by the creditor and is accepted by the bank of the debtor. The creditor can discount the bill of exchange either with the broker or bank. So in the last case, bill is drawn by the debtor. There is also the foreign bill of exchange, which becomes due for payment from the date of acceptance. The rest of the procedure is same as for the internal bill of exchange. So promissory notes and bill of exchange are known as trade bills. These bills are drawn for the payment of the goods purchased on credit or supply of the raw material. Next is the treasury bill. The major instrument of the money market is the treasury bill, which is issued for varying periods of less than 1 year. So it is the short term in nature. In India, the treasury bills are issued by the government of India at a discount rate generally between 91 days and 364 days. Next is the call market. Everyone would have heard about the call money market, in which funds are borrowed and lent for 1 day. So it is a shortest period. In the notice market, the call market, they are borrowed and lent up to the period of 14 days without any collateral security. The borrowing firm need not provide any collateral security, but deposit receipt is issued to the lender by the borrower, who repays the borrowed amount with the interest on call. So they have to pay interest. In India, commercial banks and cooperative banks borrow and lend funds in this market, but mutual funds and All India Financial Institution also participate only as a lender of the funds. Another important instrument is interbank term market. This market is exclusively for commercial and cooperative banks in India, which borrow and lend funds for a period over 14 days and up to 90 days. The maximum period is 90 days without any collateral security at market determined rates. Another important instrument is a certificate of deposit. It is issued by commercial banks at a discount on a face value. So the discount rate vary from time to time based on the rate prevailing in the market. In India, actually the minimum size of the issue is rupees 25 lakhs with a minimum subscription of 5 lakhs. So the maturity period lies between 3 months, minimum period is 3 months, maximum period is 12 months. So another important instrument is the commercial papers. Commercial papers are issued by a highly rated companies to raise short-term working capital requirement directly from the market instead of borrowing from the bank. So there are different methods of raising finance. Offer through prospects. That is also one of the method of raising finance. Another important thing is a right issue. What do you mean by right issue? This is instead of raising the money from outsider, the existing shareholders, they can raise it through the existing shareholder. That is called as a right issue. If the shareholder chooses to execute his right and buy the shares, he will be allotted new shares. However, if the shareholder chooses to let go of his right issue, then this share can be offered to the public. If the existing shareholders are not interested to buy these shares, that shares will be issued to the general public. EIPO, this is also electronic public offer. This is one of the important another method of raising finance. An agreement is signed between the company and the relevant stock exchanges known as EIPO. This is also one of the important method. This makes the process of IPO speedy and efficient, because the company will have to hear, one of the important thing is the company will have to hire brokers to accept the application received, and register to the issue must be also be appointed. A person who takes over the control over the thing is called as a registrar. He will monitor the thing. So next is a secondary market. Secondary market is in the capital market is divided into two categories. One is a primary market and secondary market. So what is secondary market? Secondary market, the after the shares are raised in the issued in the primary market, that is moved to the secondary market for sale and buy and sell. Secondary market is described as the financial market where the securities that are already owned by the investors are bought and sold. Resale is taking place. Several other names like popularly known as the secondary market. So this is the stock exchange, NSE, BSE, all these things we have already discussed. So what are the tools and players in secondary market? That is derivatives, fixed income, hybrid instruments, that is include convertible debenture, preference share. So these are the things. Important players in secondary market are retail investor, financial intermediaries. This we have already discussed what is financial intermediaries, mutual fund, insurance company, brokerage and advisory services, security dealers, commercial. So these are the various people act in the secondary market. Thank you. So I think it's very clear to you what is meant by capital market